We're coming into the home stretch and we're finishing strong with our next presenter, Larry Gaines. Now, Larry is the founder of Power Cycle Trading, and he has over 30 years of experience trading and investing significant capital in the oil, foreign exchange, and financial derivative markets. Now, Larry's passion is options trading, and since 2009, his focus has been on developing a low-risk price cycle trading system that's been very effective at consistently achieving higher profit margins with smaller capital investment. And with that, I'd like to turn things over to Larry.
Well, let's get rolling. Well, again, thanks for having me. This is starting out to be a lot of fun, so I'm glad I'm here. So appreciate it. All right, so pleasure to be here. So I'm going to talk about some really great option strategies that are really great for any market environment. But when we get into crazy kind of market environments with a lot of uncertainty and a lot of potentially higher volatility, these are the ones I like to go to. And I've got an extra one in here I'm going to show you today. So these are all based on pretty much selling volatility and selling time. So we can take advantage of those two big option pricing components to do a lot of really cool things with options. So let's get going. So the following presentation here is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. Now, to me, the secret to trading profits really comes down to three major things: price direction, really good timing, and then really great risk management. And for the risk management side, it all comes down to options and different option strategies that I like to use, primarily option spreads. Now, option trading has so many more advantages than just trading the outright stocks. But as probably a lot of people here know, it can be a bit more complicated as well. But once you understand the benefits and the advantages of options, and for me, it's option spreads, you're never going to really look back. So when used correctly, option spreads are going to provide you defined trading risk, can really lower your capital at risk, provides greater trading leverage. And these are strategies that are kind of unmatched for your hedging advantage. Now, over my 30 plus years of trading options, I found that the most valuable go-to option strategies that can really help any trader or investor more than any other trading strategies are the butterfly and the Long Condor option spread. Now, the huge advantage of these strategies are their unique option framework that allow you to construct trades that will provide you more consistent and greater returns in any type of trade environment. So especially when we get into kind of higher volatility markets with a lot of uncertainty. So the reason is because you can structure trades that only require a very small amount of your hard-earned capital. And your trading returns can be fantastic because of this low capital at risk. So you can basically get into trades with very little at risk, but have potential for big major wins on these trades that you structure. Now, when we look at the butterflies and long condors, they're very dynamic and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade the butterfly and the long condor, and you're going to be covered for both your offense and your defense. So your profits and your hedging, so goals and protection. And that's kind of what it's all about, that combination of, let's make some income or profits, but also let's protect our profits or let's hedge our profits. Now, these two strategies can work no matter what the markets are doing. They can be up, down, or sideways. They're really great to provide income from stocks that are going nowhere. They're going to help to eliminate the stress of having to be perfect on a stock's direction or overall market direction. Really helps to eliminate the time decay expense that you encounter from buying long options. And that's a real, for any option trader, that's one thing that you pull your hair out, with the theta decay that you get if you're long options and the price is going nowhere. So these are great for, compensating you for that. And then they're going to really help to take the unsettling guesswork out of your trading, because you don't have to be exactly perfect on the direction or the timing because of the option selling components that are built into these strategies. And they can be structured for very low cost, so low capital at risk, which is a great thing. And they can offer you tremendous risk to reward or reward to risk of 10 to 1 or higher. So you put up $1 and you can potentially make $10 or 11 or 12. So this option strategy, the butterfly, from that standpoint, has got the highest return on capital of any basic kind of option strategy out there. Now, the other benefits to the butterflies and condors are flexible, as you're going to see ahead. And once you learn the fundamental setup, then you're going to be able to adapt these option strategies for your goals and your market insight. So if you're more, kind of swayed or looking at a market more delta neutral or kind of sideways, you can kind of structure it that way. But to me, the real beauty is they can also be used for direction or directional trades. So kind of giving you that bullish or bearish exposure to the market when you feel pretty confident of a potential stock heading in one way or another. But if you are wrong, then the butterfly and long condor are going to help you to keep that risk lower, manage that risk, and at the same time have that potential to retain that potential for large returns. And that's always a win-win situation in your trading. Now, let's be real. These types of option spreads, though, are not going to give you that unlimited profit potential, such as if you just go out and buy calls. But they're going to usually cost you a lot less than buying the outrights, and they're going to really offer you an amazing risk to reward type trade setup. So this means that the butterflies and long condors can significantly increase the probability of your winning trades while also at the same time reducing your risk. And to me, that's really what it's all about. So when I look at a trade, the first thing I look at is what is the potential risk, and then I look at what is my potential profit and go from there. So I'm really kind of alert to what is the risk, and I have certain parameters for that, and that's why these spreads are so great. Now, when we look at the long condor and the butterflies, they're also fantastic for hedging. So when you mess something up, not that anybody here would ever have a lousy trade, but when you do, these can be a really fast, low-cost way to cover your you-know-what pronto. And I've literally found no other hedging strategy that comes close to using the long condor or butterfly hedging strategy for your core positions. Now, by constructing either a butterfly or a long condor around a strike that is under pressure from another core trade, so if you've been trading credit spreads, I don't know how many people here trade credit spreads, but they can be great. You can be going along and you've got 7 or 8, winning trades in a row, and then all of a sudden you have one that goes right through your short strike and it blows up all your returns. So one thing you can do with a butterfly or long condor, you can actually hedge credit spreads when they start to get into that position where you're getting threatened for your short strike, or we can use it to hedge a debit spread that's going against us. So for me, it's been the best way I've found to immediately neutralize, control your risk, but it's also going to reduce your risk when you do these kind of spread strategies around a core trade. So, think about this. So you put on you have a position open, and all of a sudden, everything looks great and it starts to go against you. And then you're, in that situation where you either have to stop it out or you decide, no, I think it's going to hold support, and you don't stop it out and it breaks that support, and then you've lost it, that whole trade. So that can be very, aggravating as a trader and hurtful, as far as your profits. But what I've found is by constructing either the long condor hedge or a butterfly hedge around a core position, what it does is it takes advantage of the option selling component within the spread, and that's going to take advantage of letting you wait out potentially a trade for a while and take advantage of the time decay while you're waiting. And a lot of times that's all you really need, just that little bit more time, to have that trade neutralize, stabilize, and then move back in the direction you originally set it up for. So while you're waiting, you get paid, and that's a great thing with options, and especially when you have an option selling strategy to take advantage of, the sell side. So at that point, you just remove your hedge and go with the original trade and ride it for what it's worth. So if I have time, I'll show you some other current examples, but I'm going to go through here in a few minutes a lot of different trade examples of butterflies and condors, and also the calendar, which is another really great option selling strategy. Now, when we look at the core basics of a butterfly, it really comes down to matching vertical spreads. So when we trade options, we have vertical debit spreads, vertical credit spreads. So if you look here, this is just a kind of a vertical, like a debit spread. So you could be long a call, short a call. And so your risk is defined on a debit spread, which is good. So in this example, $300 right there. Now, we're looking to make max profit if it closes above the spread width of the short strike. So if the spread starts to go against us, though, we could immediately neutralize and reduce the risk of this trade of $300 by adding a vertical credit spread to it, which would then convert it to a butterfly. So all I have to do then is sell a credit spread sharing the same short strike as the debit spread, and in this example, bring in $200 credit from that. added to the debit spread, and boom, I've got what we call, this is a balanced butterfly. So we've got the original trade here, which could be the call debit spread, long a call, short a call. And then I sold the credit spread, short a call, long a call here, brought in 200. So now I've reduced my risk down to $100. So I've got a lot of different options now as to what to do. I could even leave it on and do nothing. And if it goes out within my profit zone here, make a really good profit and a really great return on that lowered capital at risk. Or I could leg out of the long side or short side, or I could add additional credit spreads to it. So it just gives you a lot to work with once you understand the basic concepts of options, which really come down to vertical spreads. Now, when we look at the Long Condor, it's very similar structure to the butterfly. And the thing I love about the Long Condor, we can use calls or puts, but the thing I like about it is that it widens out your profit zone. So with the butterfly, you would have your short strike sharing the same short strike as if you did a debit spread on a call or put. So it's right here. So you've got kind of a tighter window or needle to thread to get your max profit. But if there's enough premium, I like to go out and widen that spread out. And then I've got this bigger profit zone. But we've got the really great advantage of a long option trade for that potentially good profit, but also the selling options side of the spread trade for taking in premium of, selling time and volatility. So we get the best of both. And that's what I like most about, combining vertical debit spreads with credit spreads. I can construct a lot of different strategies to get the benefit of your long option and a short option together, but also having captured or capped risk. Now, when we look at the butterfly and condor, long condor, which are amazing, we'll go through a lot of different examples. But first, let's go through the kind of core concept. What makes these strategies work? So when we look at the most important option factor for really trading in general of options, it really comes down to understanding pricing of your options and the concept of time decay, the impact that has on the price of your option. So time decay is also what we refer to as to the theta of your option. So that's how much it's going to go down. That time is how much the decay that option price has, how much it will go down each and every day as it gets closer to expiration. And the key point is that both time and volatility go to zero at expiration. So that's what we take advantage of when we're selling options. So when we look at the core concept of theta, theta is what tells us how much that option pricing will go down over time, and that's the rate of time decay of your stock option. Now, this decay occurs because that extrinsic value, which is the time value, goes down each and every day and goes to zero at expiration. So we want to take advantage of that, and we can do that with option strategies that have a component of selling time and selling volatility, which the butterfly and long condor do. So let's take a look at the different variations, but first we'll go through a kind of a key example so you can kind of see how the price works. So in this example, XYZ is trading at $45. And we're looking for a move down to 43, just kind of a target. So I always look at targets. Whenever you do a trade, one of the first things we do, power cycle trading, there are kind of 7 steps that I follow in any trade setup. And one of the key steps is always have a price target. So before you put the trade on, have a target. Where do you think the trade's going to go? And then that's how we construct the trade. We construct it based on our target. So for price targets, I use Fibonacci, any key moving averages, and option activity. So in this example, let's say we think it's going to go to 43, just a couple dollars down. So how can we do a really low risk trade? So here's an example of using butterfly. So you buy the November 44 put, you pay $2.38. Now, remember, one option contract's equivalent to 100 shares, so that'd be $238. And then we're going to sell the November 43 put against it. So if you look at that, you've constructed a put debit spread. So you're long the 44, short the 43. So that's like a bearish directional trade. And you brought in $1.67. Now we're going to do another sell. We're going to sell one more of the 43 put. We're going to bring in another $1.67. And then below that, to cap the risk, we're going to buy the 42 put, and that's going to cost $1.06. So if you go through the math here, you can see that 44 put, that's a debit cost of $2.38 right here. And then the 42 put's $1.06. Then less, subtract out your 43 put, you sold that twice. So you brought in $1.67 twice, times 100 to convert it to the option contract. And in this trade, you can see your maximum risk then is $10 per option spread or option butterfly. So that's the beauty. We can really define and get risk super low, but still have potential for a big reward. So then if we look at the potential profit, you just basically take the middle strike, 43, less your lower strike, 42. So that's a dollar wide spread, less your credit, less what it costs, the debit cost here, times 100 to get it to an option contract. And you can see in this example, you would end up with a potential to make $90 per option spread. So on this one butterfly trade, theoretically, you can make $90 and your total risk is 10. So that would be a 900% return. All right. So you basically are risking $1 to make 9. So that's the thing that's so fabulous about these types of strategies that, if you get into a really, kind of a uncertain market environment and you really want to keep your risk defined, this is one way to do it. So here's another example. So this is like the ETFs are fantastic also for these trades. So here's an example of an SPY butterfly, call butterfly for upside move. So buy the 203 call that cost $310, okay, for one contract. Then sold the 205 against it, brought in 170 credit there, sold the 205 again and brought in another 170. So now we've got a credit of 340 and then bought the 207 call above that 205 to cap that risk. So it's a capped trade. So you have no naked options. So you can do this in any kind of account. You just have to have the margin difference. So in this trade, you can see that the maximum cost of the trade is actually a debit. So you don't have to have the margin. It's $40. All right. So this trade is $40, but your potential profit is $160. So if you just take the spread width of $200 less your cost of the trade of $40, the potential theoretical profit is $160. And I'd say theoretical because on a butterfly, you'll never get that exact because it's too hard to kind of thread that needle perfectly. But if you look at that $40 of risk, and if you did make any, 160 or close to it, look at your return. It's 400% on that. So, if you got up to, if you made $80, that's 100% return, right? Or if you made, 160, that's, four times, right? So it's just an amazing strategy to keep your risk super defined low and give you potential for a big payoff. And it's a positive theta, so you don't have to worry about time decay. So let's take a look at a bunch of these different strategies so you can get an idea of the best butterfly and condor strategies for you and your trading goals. So one major goal of every trader, really in my opinion, is to look to select trades that are going to be based on what's going to give you the most consistent positive returns over time that also are low defined risk trades and not always the greatest kind of home run hitters. So to me, you want to be kind of a smooth equity curve, from that bottom left to the top right, rather than having it all over the place. It's going to be a lot less stressful for you, and you'll stay in the trading game or business a lot longer doing it that way. So just, look at trades. I like to look at the strategies that can give you singles and doubles, then occasionally you get that, triple or home run. And that's what these kind of strategies can give or provide for you. So the best way then to determine what option strategies to use is to first look at your capital that you're trading, understand the times of day or, when you can trade. And, basically everybody here today will have a different amount of capital that you're, putting up for your trades. So Charlie might have 10,000 trading account and Mary has 100,000. So it's going to make it different on your risk profile. But the one thing when you learn these types of option strategies, the butterfly or condor, you can do it with any size trading account. It doesn't matter if you've got a $1,000 account or 5,000 or $1 million account. So these are strategies that, the big hedge funds use, institutions use, but also the small retail traders. We can use these too, and we can really use them to our advantage because we can get in and out of them a lot faster than the big guys. So that's another great advantage to the smaller trader. So let's take a review here of the different strategies. So we're going to look at a bunch of different examples of butterflies. We'll start there first. Now, when we look at the butterfly spread, we can use or adjust the risk and the profit of a butterfly spread based on the wingspan of a spread. So if you think about if you were trying to catch a butterfly or something, let me see if I can pull up my drawing tool. I always have trouble with this for some reason. Okay, so let's say you're trying to catch a butterfly. So is it going to be easier to catch a butterfly if you've got a really tiny little butterfly net? Or would it be easier to catch a butterfly if you've got a really big butterfly net? All right, so same concept with the butterfly. So if we can make a very wide wing butterfly like this, and I'll show you some examples, and we have a big wingspan, so we have a big profit zone. Now that will increase the potential capital that we put up for risk, but it also will increase the profit, but also the probability of that trade working. Or if we really want to define to keep our risk super low and have still a big return, we can narrow the wings of that butterfly and have it very narrow. So it gives you a lot of flexibility for the trade, for the various market conditions you might be trading. So that's kind of the first thing to kind of think about how this works. And let me see if I can get rid of this. First off, let me erase that. Here we go. Okay, so that's kind of the first concept to think about. So the first one here I'll show you is a narrow wing butterfly, and this is a dollar wide spread or $100. Okay, so that's about as narrow as you can get. So this is again on the SPY, the ETF for the S&P 500. And these are really great strategies for short duration trades or, short price movements. So, or, longer duration, but really great I like to, my time frame is a swing trade time frame. So a trade that could last typically a day or a week or 2 weeks would be kind of the longest kind of time frame. But in this example, you can see this was on the 14th, and then expiration was 2 days later on the 16th. So these are great to set up, on like a Tuesday, Wednesday for the end of week expiration, or I like to set these trades up a lot of times maybe on a Thursday, Friday for the next week's expiration to take advantage, because what these are doing, they have that selling component. So that's what's going to take advantage of that accelerated time decay if you've got a shorter duration option, and also take advantage of volatility collapse or volatility going to zero. So in this example, we wanted to just move towards the 618 fib level. That's what I use typically for targets. And there was a lot of option activity there as well. So it gave us a very good target. And at that point of time, it was trading about 265 right there, and we were targeting 273. So in this trade, it was just going long at 272 call, selling the 273 call, and then selling another 273, buying the 274. So if you break it down, there's a call debit spread, and then you added a credit spread to it that creates that butterfly. And this is a very, very narrow wing butterfly, dollar wide. So that'd be $100 per spread minus your cost of the trade. And this one, you can see down here at the debit cost is 10 cents or $10 per option contract or spread here. So the difference then would be your potential profit, $90. Okay, so if this went out hitting at 273 at expiration, you theoretically could make 90. Now you're never going to make that exact. I've never made it exact, but you sometimes can come pretty close. But if you did, that's a 900% return. Now 2 days later, this trade though is up $70 per spread on $10 of risk. That's a 700% return. So where can you make 700%, right? I mean, there's even trading options, unless you're just, outright long or call or something, but on a spread, you can't. Now, here's what it looks like. And what it's doing is taking advantage of the time decay and the volatility collapse, which at expiration, those are the two components that go to zero. So that's what we take advantage of with the butterfly that has that selling component. So here you can see that it went from a 10-cent debit or $10 per spread to 80 cents or $80 per spread. And then that's your $70 per spread profit on the risk of 10. So that's 700%. So this example is like 4 contracts. That's up $280. Maximum risk was on 4 contracts, $40. So that's the beauty of it. So high return, volatility collapse we're taking advantage of, and time decay. So that's an example of a narrow wing. Now the next one is a short trade, again using the ETF, the QQQ for the NASDAQ 100. Now this is a wider wing butterfly. So we're going to expand it, give us a bigger kind of a profit zone or net, and also increase potential return or profit, dollar profit, basically, not specifically the return, but the profit is going to be larger the wider we do the spread. So this is $300 wide. And on this trade, we're a downside directional trade. So I like to look for, this is what we call a retracement failure. So if you look here, this was the QQQ right here. This is a daily chart. We'd had a big sell-off. And then typically what you have on any kind of sell-off, you'll have a big hard sell-off, and then you have these kind of retracement rallies or reversion to the mean type rallies. So you can see it reversion up here to the moving average, failed again, came down a little bit lower, and then had another retracement here. So we were looking for that retracement and a failure, and we wanted to do this short trade with very low risk. So the lowest risk trade we could think of was to do it as a butterfly and then targeting a fib level, which was down to 270, 265. All right, so we always have the target first to trade against, and that's how we set up the spread. So our price target was 270 based on the Fibonacci levels that we were looking at. So if you back up here, well, I don't have the fib levels in here. It was like right in here, 270. You see that support right through there? So that was the level. So we did a 273 put long, short the 270. So our target's typically the body of the butterfly. So targeting the 270. So then sold at 270, bought the 267. So that's this put butterfly for directional move down. So in this trade setup, you can see the spread width is $3 between the strikes. So $300 less the cost of the trade. Again, look at how low this cost is, 30 cents or $30 per option spread. All right, so your potential is the difference of 270 per spread. And on your risk of $30, that's a 900% return as well. All right, so going into this trade, you have the potential for a big payoff, but when we hit our targets, you take profit. So in this example, it hit down 2 days later and we took the profit, but it was still a good profit, 216% return. So fantastic still return. So here's what it looks like on the analytics. This is the risk profile of the trade. And this was on the 18th expiration. So it set up the 16th and expiration was the 18th. So it went from that the 275 level and hit down to our target and was trading at 271.18. So right here, you can see 271.18. So right there, that purple line there is what that trade is doing in time. Okay, so at that point in time, it had gone up to from 30 cents or $30 per option spread to 95 per spread. So there's your profit of $65 per option spread. So one spread would be 65. If you did 10, that'd be 650. But the return then on your risk is 216%. And your risk, though, is only $30. So that's what's amazing. You can see the theta here, positive theta, 87. So that's what the big payoff too is you get positive theta. And then if you stay within your profit zone, that goes to zero at expiration and you keep the theta that's in your option spread or the volatility that's in the spread. So those are the two big option pricing components. So that's an example there of how you can use it for a downside move, but have your risk really structured low, but a potential for a big payoff. Now the next one here is another example for another ETF, GLD. So these are really good ETFs for the gold ETF for butterflies as well. Good liquidity, great for any kind of option spread, but really good for certain situations for a butterfly. So we did this directional trade, and this was a $500 wide spread. So this was a pretty cool trade because what we did on this one, I like to kind of do a lot of different option structures. This trade originally started out as what we call a calendar, which I'll show you here in a minute. But what the calendar does is basically it's also an option strategy that sells time and volatility, but it's a little bit different animal. It's kind of like a butterfly, but the difference is that your short leg of the trade is closer in than your long leg, so you get the advantage of the theta decay or premium decay on the shorter duration option. So I'll show you here an example in a minute, but we set this up originally as a calendar targeting 170. Then when we got to 170, we decided, okay, well, let's turn this into a butterfly because there's a lot of option activity at the 175 strike here, and that's a good fib level. So then we kept the same trade, just did an adjustment, converted it to a butterfly, targeting 175. So let's take a look at that. So what we did was we did the 170 long call, short the 175, then sold the 175 again, bought the 180. So $5 between the strikes, so $500 minus the cost of the trade. Again, very low capital at risk. The debit paid $89, okay, super low. So your potential profit is $411 per spread. On your risk of 89, that'd be a 462% return. Now we hit close to the target right here. You can see this was hitting right there on the 22nd. This one was set up on the 8th, so this was a little bit longer trade. But on the 22nd, it hit into our profit zone here, and gold was starting to move quite a bit. So we went ahead and closed the trade right in this area here when it was trading right about 174.55, pretty close to 175. But, it's not going to be a max profit unless you're at expiration, but this was close enough. So went from $89 here to $299. So there's your profit on this trade of $210 per spread for one spread butterfly or whatever. And so on your risk of 89, that's a 236% return. So again, low risk, high return, take advantage of theta decay and volatility. Now, this next one is a great example to show you the other great advantages of a butterfly. Not only do you get the benefit from kind of a low defined risk trade, but you can trade the big guys like Amazons and the Googles and the Teslas, the higher price stocks. You can trade these stocks for very little capital, but also give yourself potential for huge returns, and also give yourself the advantage of taking advantage of time decay and volatility decay. So let's take a look at this one. So Amazon was trading down here again. I like to use direction. So it's bouncing off this. This was a 200-day moving average. So we were targeting this 1830 level right there. But as you probably know, Amazon can be pretty wild. So we wanted to do a trade that was very low risk in case we got it wrong. So this was going long when it was trading right down here around this 1763, just for a move up to 1830. Now, if you think about it, if you took a trade on Amazon and you bought, one option contract, 100 shares. So let's say you bought 100 shares of Amazon. It was trading here at 1,782. So you would have had a lot of risk. If you bought 100 shares, that's $178,200 that you would put up for this trade. Now, it did go up and it hit that 1830. So you would have made $48 per share. But on all that risk, that would have been a 2.69% return. So not many of us would probably ever think about doing that trade. But with the butterfly, look at this. We were targeting 1830, and we could do that with the butterfly. So bought the 1820 call, sold the 1830. That was our target. Sold the 1830 again, bought the 1840. So $10 wide. Okay, so that's $1,000 spread width. The cost of the trade was 80 cents or $80 right here, 80 cent debit. So you could do one option contract or 10 or whatever, but the cost was $80 per spread. Now you're doing that and you're controlling a stock that's worth over 178,000. You're controlling it for $80. So that's the other thing that's pretty amazing. Now, if this was to go out at expiration, it would make right at your your body here, your target 1830, this would make $920 on your risk of 80. That'd be 1,150% return. Versus if you got it right here, you made a 2.69% return and you had a risk of over $178,000. Here you have a risk of 80. So there's no comparison from that standpoint. Now the other advantage is time. Okay, so here it is on the 6th in the morning, a.m. So this is about 9:30 or 10. So it was the day of expiration. Now it was hitting here at trading at 1836.55 right here. Okay. So it had gone over the 1830. So it was kind of outside that zone, but right there it was trading. And at that point, it was up $150 per spread. So it went from 80 to 230. So $150 per spread on your risk of 80. Still, that's a pretty great return, 187. But what you're going to see here is just 3 or 4 hours later, the same day, this goes up 4 times in value. So later in the afternoon, this trade was now trading right here, very close to where it was earlier in the day. Came back a little bit closer to the short strike, but not much. But look at the return here. So now it went from $80 to $695 or $695. So now it was up $614 per option spread. And on your risk of 80, that's a 769% return. So increase in value of 4 times what it was in the morning and 4 times your return on capital, that afternoon. That's in the same day. And what does that for you is that time decay going to 0 towards the end of the day and volatility. Those are 2 main option pricing components, that sell side of the option spread. So you get that beautiful advantage as well. So a lot of different advantages here, controlling a big stock, keeping your risk low, but also have potential for a big payout. Now, the next one will be the Long Condor spread. And so this is another trade setup very similar to the butterfly. So we're going to have a vertical debit and a credit spread together. So we get the kind of the advantage of getting the more of a lower theta value, but also lowering our capital at risk and a high return on capital. And this is what I like to go to first for a hedging. So we can do this with calls or puts, either one. So we could do a call, long call spread and then add that credit spread to it to reduce our risk, reduce our theta, or we can do it with puts, for a downside move. So here's an example of a SPY put debit spread that we adjusted, corrected, or converted to a long put Condor. Now, also when you're trading, the other really cool thing with trading options is that if you think about when you're trading, the other thing you always want to do with your trades is have a profit target, but also think about what are you going to do if the trade goes against you? What's your kind of your trading plan? And then also, what if the trade goes into the direction of your profit zone? What are you going to do there? Can you enhance the profit? Can you increase your profit by maybe making an adjustment with a different option spread? All right, so I'll show you what I mean by that. So here it was trading right here about 275, and we're looking for this to drop down to this Fibonacci level here, about 270. Okay, so that was our target. But a lot of times, you'll exceed the move at the first time down and then maybe pop back up like I did here, retracement. So that had been happening a lot. You go short, you get down here. If you didn't take profit, you retrace, it goes up there and you missed your chance a lot of times. So in this example, what we did, we set up the put debit spread, the 273.70. And then when it hit down to our target, you had a couple of different options. You could take the whole trade off. And at this point in time, it traded from 275, hit that down there to 271 area. So it was took profit, partial profit of $98 per spread. So the risk though here was super low. It was a $300 wide spread. The cost of the trade was 65. So potential profit 235. All right. So pretty good return. But took part of the trade profit and then converted the other to a put Condor. So that's 150% return. But what had been happening in the market a lot of times is it'll snap back up. So instead of closing the whole trade out, took partial profit, then converted the balance to a put Condor by selling the 268 put short, buying the 265 put below it. So that's a bull put credit spread, brought in $65 credit. So that offset the debit cost of the put spread. And boom, now we have a zero risk trade. And our potential profit, if it goes out between the short strikes here, would be $300 on zero risk. So that's a great situation to have, zero risk. Then you can just sit back and see what happens into expiration. So it was going out right here about 271.30. So closed it out there. So you can see here it went from $65 and now it was up to $165 per profit spread on zero risk. So trade one, if you'd taken it off, all of it there, you make $98 or 150% return. But if you'd done the conversion for zero risk, you also made 164. So that's just the kind of the flexibility you get once you understand how to use these types of trades. Now, one more I want to show you. I just threw this one in because the income calendar is very similar to a butterfly, but what it does, it's a little bit different because you're going to have your, let me go through it, but what it is, it's a delta neutral strategy, or you can do it directional, but it's a very kind of delta neutral type setup. But the strategy is also selling time and volatility like a butterfly, but it's doing it for a debit, kind of like a butterfly too. But what is the beauty of this one is that your rate of premium decay and implied volatility, you get a big advantage because what you're doing, you're selling short a near-term option and buying a longer-term option as your hedge against it. So kind of it looks like a butterfly as far as your target. You do the same target price, but you're going to do different option series, and you're going to have your short and the really near-term series to take advantage of that accelerated theta decay. All right, so we're going to structure these always for positive theta, and they can be done for very low risk and also done for debit. So in this example, what you would be doing is you're going to be selling, let's say you sold you had a calendar and you sell the short strike, you sell it short 30 days out, the $100 strike right here 30 days out, and then you buy the $100 strike 60 days out. So it kind of looks like a butterfly, the structure I'll show you in a minute. But you're playing the theta decay. It's also called a horizontal or timing trade because what you're doing is you're shorting 30 days out buying 60 days out. So you're getting the advantage of that theta decay really accelerated here, and also volatility accelerating to the downside as well. So here's kind of what we look for. So if you look here, this was on a Gilead, but you can see the theta right here. This is the advantage. This is what you're trying to take advantage of. It's trading at $73 right here, okay? So if you look at the theta decay here on the long option call, it's 34 cents, 1 day at expiration. Now look at the next series back, 8 days to expiration, $16, and then the next one is 11. So we're playing that differential, that theta spread right there, 34 less 16. So for 1 day, we're going to make the spread difference of, $15, $16 there, plus the implied volatility. This is what we call horizontal positive skew. It's 92 here, 87 here. So we're taking advantage of selling higher volatility and buying lower volatility. So these are also great for very low, kind of a lower risk, but defined kind of short movements if you want. So this was an example on Intel, and we were looking to target, it was trading at 50, and we're just targeting 51.25 in a very short duration trade. So see how it looks kind of like that butterfly structure, but we're going to be short here. If you look here, we're short the 4 September 51.5 call and long the 2 October 51.5. Done for debit costs in this example, $85 per spread, max risk, and then it popped to 157, and so that's $72 per spread, or 85% return. So these are kind of an income type strategy. So really nice, kind of a similar to the butterfly in a way. That's why I wanted to put it in and show it to you. But big theta, see the positive theta here, and delta neutral, very, very low delta. And here's another really good example. This was Microsoft. It was trading at 189.30. We're targeting 195 up into this fib level here. So we could do this really low risk trade too. So we sold, this one was selling the June, this was back in June, sold the June 12, 195 put, and then bought the week later, the 195 put. So just a kind of a weekly option calendar, $85 max risk per spread. And then it went to 176. So, trading right there. So from 85 to 176, $91 per spread, or 107% return. Now this is what we did on GLD. We hit our target, and then what I like to do a lot of times is then adjust it, turn it into a call debit spread or a butterfly. So I wanted to go through and try to show you all these different really great strategies, and to give you an idea of what you can do once you understand the concept of option spreads. So a couple of things you can do now. Hopefully you got enough out of this presentation today to kind of start using some of this tomorrow. But if you'd like to really learn how to master these trades, I've got a really great offer for everybody here for the presidential nice offer here. So if you want to use this link here, powercycletrading.com, and then let me get the, here's the link. If you put this in here, click on that link or copy it and paste it in your browser. So it's powercycletrading.com/to-fly, to fly, all right? I've got a great 9 bonus package for everybody here if you sign up here today. So let's go through that, and then if I have time, I'd be happy to take some questions. So what you're going to get is this is a butterfly course I did a few months back. So this is a really 6+ hour options masters course on the butterfly and long condor. Okay. So this is, you get the 6-hour recorded course broken down in modules of 30 minutes or less. It's yours forever. And the PowerPoint of the course, my courses are very detailed. So you get all that. Now the bonuses, I'll put a bunch of good bonuses. So you're going to get my new options beginners course. So anybody here that's just starting out on options, this is a great program for you to get into. For just $97, you can stack your library full of great option training, and all of this is yours, forever. So you'll get my options beginners course. Now that goes for $97. You'll get my options beginners program, another really good options beginners course. You're going to get my stock portfolio hedging tutorial. So I put this together because this crazy market. This is a tutorial with the videos to show you how to hedge a stock or a stock portfolio using what we call a protective collar. So this is a really great little additional bonus for everybody. And then I just threw this in. I thought today, if you'd like, the calendar has such a great advantage to the markets. So I wanted to give you the chance, if you wanted to, you could have this course that I did just in September. It's my calendar diagonal spread course. On the website, it's $397. I'll show it. Now, you'll also get a live follow-up support Q&A. This will be probably a week from now. We'll send you a link to that. You'll get my option trading tutorial, just another option, basically course with videos and stuff on Greeks, probabilities. My option strategy manifesto, 15 different option strategies. You'll have that. My power tool guide, that's something you can print out to show you what the Greeks are. And then you're going to get a one trial membership, a free membership to my trading club. And you can start that whenever you want. You don't have to start. If you buy this today, you don't have to start it tomorrow. If you want to send us an email, support at Power Cycle Trading, start it whenever, a week later, 2 weeks, whatever. And then if you stay in, once your time runs out of 30 days, it's $97 a month. Or you could do an annual membership for, like right now we have it for $488. So you're going to get all this stuff here. So you're going to be stocked for your library for over the Christmas season to start rolling on mastering options. But you'll get first this options masters course of the Butterfly Condor, Long Condor. So everything's broken in 30-minute modules or less. 437-page training manual. All my courses are, based on trade examples. So, you can kind of look at it. To me, that's the best way to learn, just kind of visually like that. So it's kind of a step-by-step blueprint course on trading the Butterfly and Long Condor. So for the various different income, profits, reward, directional hedging, and more. So part one, I take you through the importance of the various Greeks that are super important for the Butterfly Condor, how Theta Decay impacts it, how volatility impacts these trades, and then how option pricing works. So not only will this be helpful for these trades, but any of your option trading. And then how to use standard deviation. That's what we use for kind of forecasting our price target direction. That's one thing we use. So this will be helpful for any of your option trading. And then go through the core basics. Most people just don't understand, well, why would you ever use the Butterfly or Condor? So after going through this course, you'll know exactly why. And then I go through all the different variations. I go through how, why, and when to use the long call or put butterfly, wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation, long condor. So there are a lot of different variations. So in this course, it takes you through every variation of how, why, and when would you ever use a different variation of the butterfly. What are the best time frames for the butterfly? What are the best instruments, stocks, ETFs. So spend a lot of time there. How do you get those structures where you risk $1 to make 10, or actually I showed you some examples where you can make a lot higher than 10. You should be able to type in that powercycletrading.com/2fly. And if you click on that, it'll pull up a payment link. Yeah, I just clicked on it. So if you pull that up, it'll pull this payment link up. And if that doesn't work, then you could just type that in. You just put powercycletrading.com/2fly. But if you click on that, it'll pull it up. So I'll show you here. So I'll just pull this up here. Click on that. You'll see it start pulling up right there. So here's my Power Cycle Trading. If you go here, you'll see the courses. So this course is for sale on my website. It's $397. So is the link working now?
Yeah, Larry, the link is working.
Hopefully it's working now.
Yeah, it's
and if
working.
It's not, you just, like I said, you could just type it in. Okay, great. Sorry about that. So you're going to get this options master's course. And then I go through another sector of the course is monthly option expiration. So I don't know if, we're going to have monthly option expiration next week. So 12 times a year, we have monthly expiration. And that's a really great option time of year to trade options for what we call pinning. So trying to pick where a specific stock strike will go out at expiration. Then what we do is we trade a butterfly around it to take advantage of that volatility and time going to zero. So this is another kind of stream of income that you could use. So in the course, it teaches you how to do that, and it teaches you how to set your target prices using option activity and Fibonacci. So I'll take you through the Fibonacci side of things too in this course. And then we go through in the course the Long Condor. So when to trade the Long Condor to take advantage of the, mixing the vertical debit spreads and credit spreads. And this is a strategy that also gives you these high returns on your capital at risk. And this is what my go-to first strategy for hedging. And so how, why, and when would you use the long option condors? So you can use this with calls or puts for upside or downside movement. And then the big part 3, this is a big part of the course, is hedging. All right. So we go through how to hedge and how to trade and hedge using either the long condor to hedge or the butterfly to hedge a core position, or to defend, vertical debit spreads or credit spreads. So very, very extensive part of the course is on hedging to use these two strategies where basically they're the best, the only good really strategy that I've found for hedging that's such a quick way to neutralize and lower your risk. So a big part of the course will be designed just to show you how to use these two option strategies for that. And then there's a resource section that takes you through what is assignment risk, expiration risk, auto exercise, because those are potential risks that everybody kind of is concerned about when you're selling options. But this kind of demystifies the threat of it. If you go through this course, you're not going to be too freaked out about assignment risk, because I'll show you it rarely ever happens if you know what you're doing. So this course will take you through that as well. And then I do a trading library. I like to give you a good library of old trades that you can look at to kind of go back and kind of learn from those. So 58-page trading library, butterflies and condors. So really good feedback here. Pam says, excellent class, Larry, as usual, under promise, over deliver. And this is what I hear so much. I wish I'd known how to do this hedging before I lost so much money on credit spreads. I hear that over and over and over. And then here's from Jim. Again, thanks again for showing so many ways of getting out of trouble. Everybody shows you all these different trades that you can get, great profits, whatever. But what happens when you get in trouble? Is there a way to get out of trouble? So that's what is amazing and great about these strategies. It helps you to learn how to get out of trouble, and what one of my members termed opportunistic hedge trading management. So we can take a trade that's a losing trade and turn it into a winning trade, by doing these types of strategies. And then Dan says, besides being profitable, you can tell the audience that your courses are right on point and you're expert among experts. Using alerts was instrumental in me learning more about it. So I have alerts, alert service too that you can get if you'd like. So here are the bonuses. So special one, you get the option trading for beginners. This is a new course that I put together on demand. So it takes you through the benefits of options versus stocks. Some really good insider tips. What's the difference between the puts and calls, how they work, option expiration, and two, kind of the basic beginning option strategies. Walks you through that, the cover call and the income and protection put strategy hedge, and a resource page there. And then you'll get my other options beginners home study package. This is just another really good, easy to understand option trading course for, kind of developing a trading plan of options basics, how they work, et cetera, leaps, trading account levels, things like that. And then my stock portfolio hedging tutorial. So this will get you prepared for how would you manage a stock portfolio. If you've got a stock portfolio of $1 million, $2 million, $10 million, $1 billion, this will teach you a really simple way to hedge that portfolio using what we call the protective collar. So it'll take you through how you determine how many options to use, and then the strategy itself. So you'll get that. And then I just decided, let me throw this in if you'd like. So this is a calendar and calendar diagonal course that I did back in September. This is we do a lot of calendar diagonals because they take advantage of selling time and premium. And this is a 5+ hour course on the income calendar diagonal. So if you would like this, if you take the package, anybody here that buys this today, what you're going to get once you do your package, you'll receive a coupon code, a code from us that will basically give you 75% discount on the course if you do want to buy the course. So this is on the site for $397, and but with the coupon code that we'll give you, that'll be the extra bonus. You can use that on this course here. Here's the course right there. So you can then, once you get that coupon code, you'll put that in here, and you'll get this for $97. So just another really nice little bonus for everybody here if you would like to do that, or you don't have to. All right. And then you'll get my follow-up Q&A. You'll get that, and that will also be recorded. You'll get my option trading tutorial, 60-page guide with videos on the Greeks, option delta, 15 option strategy guides. So this takes you through 15 different option strategies, how they're constructed, when to use, ratio butterflies, calendars, my Greeks, okay, and then a trial membership to my trading club for 1 month. Virtual trading room open each and every day, daily video newsletter every night after the close, Q&A every Tuesday, live and recorded, and 60% discounts on all courses and software. So a lot of great stuff, and the greatest thing about it is it's all on options, and it's just for everybody here, $97. So hopefully you guys and gals will take advantage of it, and I hope to see you again in the very near future. So thank you so much for having me here today.
Wow, Larry, that was terrific. Well, I mean, guys, just think a little bit about, just the time that Larry took to put that together and to present that very, very complete strategy on butterfly and long condor, how he makes all that work. Larry, there were several questions that came up during your presentation that were dotted throughout, and I think some of these may be redundant, but let me just fire them out to you. One of the fellows said, are you selling naked or covered calls or puts?
Okay, so I never teach any of my members or clients to sell naked. So all these,
Yeah.
anything that I teach on the option side will be based on an option spread that will be, capped risk.
Sure. I thought so. And then another person, I think they were taking a look at your charts. They were going, so do we need level 3 options access?
No,
No.
no, these are spreads. So you're not going to, be naked a call or anything. So you should be able to do these in any basic option account. So it's you're going to be, if you're short a call, you're long something against it. So they'll let you do a spread. So you'll have no kind of level 3 that you would have to have or anything like that. Or the option account would be kind of just a margin, not a margin account, but just a regular cash account you could use as well.
Okay. Another interesting question. Stefan says, can a citizen outside the U.S. trade options?
Absolutely.
Absolutely.
Yeah. Yeah. I mean, we trade options. I mean, I traded options since 87. We traded on what we call over the counter. So no futures exchange. We just traded the actual physical options on crude oil cargoes, so you could trade on anything. If anybody will make you market, you don't have to have an exchange to trade it, but we have these exchanges now. So it makes it easier for the retail guys to trade them.
Sure. George says, how many days to expiration how many days to expiration you do this trading? How to select using call or put to do this strategy?
Okay, well, that's a big part of the course. That's a great question too. So if you just here real quick, I'll show you. I use a lot like Thinkorswim. So if we just look at this option chain, here's Apple. So see all these these are different option series weekly. So here's the 13 November. So you could trade options just for 2 days into Friday, or then here's the next series, 9 days, 16, 37, all the way to Leap. So you can use all these different series. And so just all kinds of little different fun things you can do with options. If you just, it sounds complicated, but once you understand the basic concepts, you can do it.
And I think the package that you put together really addresses from beginning to advanced.
Yeah, I had a lot of people in the past said, do you have anything beginners? I like to kind of start out slow. So I've been doing this a lot. So I did this course about a month ago, Options for Beginners. So it's a really good starting point in this beginner option program. So this will get you rolling. And again, these are all yours forever. So it's not like, if you get the membership and it expires, you'll keep these and they're on the cloud, et cetera. If you forget your login or go away for a year, come back, just send us email. We'll, get you back in there. So this will get you going and, gives you a library of places to start, and then you get more advanced as you go.
As you go. Last question here, Larry. There's a lot of folks out there that, are talking about trading weekly options. Do you have a position on that? Thoughts about that?
Oh yeah, they're the best. So that's what we primarily do. So for example, here, just a quick one. I've got, this is what we call a calendar. This is on Apple. We did this on Monday. And this is what I was calling about, opportunistic hedge trading management. We set this up on a different calendar and then did some adjustments. And this was underwater. And now it's back to profits, up $16 bucks. But we structured this to convert it to a butterfly that I was talking about, where it can make quite a bit of money. So yeah, do a lot of weekly options.
All right. Larry, thank you so much for your time. We know that you're a very, very busy guy. So to be able to grab you for an hour.
Well, thank you so much. This was fun.
Excellent. Thank you, my friend.
Larry. Thanks, everybody.
So once again, folks, that was Larry Gaines with Power Cycle Trading, just one of the many real market pros that we're fortunate to be working with over the course of these past couple of days. And he shared with us his strategies for trading butterflies and long condors. He's put together that master course with all of the bonuses. It's a complete bundled option. And if you go to powercycletrading.com/2fly, you can read all about it. I'm not going to go over all the points that were raised in this, but this is an awesome package. And he has a very special price of $97 on that. So I would encourage everyone to go there and take a look at that terrific offer from Larry. Well, here we are at the top of the hour. We're winding down to the close of the day, and we have a couple more quizzes ahead of us. But let's first focus on this quiz.
We got you covered there, Raleigh. So Amazon gift card, $100 gift card. To the first correct answer, our moderators will let us know who was first. They have to watch Q&A and chat, which everyone can't see. You can only win once a day, so allow someone else to have a turn. And Raleigh, what is our quiz?
Okay, here we go.
Who is the first president to be born an American citizen?
I love this question.
All right.
Can I
Well,
hold up your ear?
Oops, wait a minute. Let me turn this off here. There we go.
yeah, I'm going to pretend like I know. So the winner was Randy. Randy, go ahead and catch the moderators with your
Congrats.
email address. And what's the answer, Raleigh? Martin Van Buren. The 7 before were all born as British subjects. You're right. She said it was a trick question.
I might have seen this one before.
That was a trick question.
What you think?
As what we were talking about, as people are paying attention to our little quizzes, they're going to be, the things that we're learning about the presidents, a lot of good trivia here, a lot of bar bets can be won with this stuff. So